Mimo, Mimo.
Okay, so today we're gonna be learning about volume and ranges. So this is this will be very simple to be honest, because volumes and ranges aren't that hard to grasp, but it depends if you can easily understand it or not. So what is volume? Volume is basically the areas where you know that it would have a lot of people being in the market. That's volume. And areas that does not have volumes are areas that people do not tend to be in the market, be entering or be buying gold or all those things. If it's real life or digital, right? So you can see here, from just looking at this is volume. All these are volume. This is not volume. Of course, you can consider it as volume, but this volume, okay, this is not a strong volume like this one. And the way we want to trade is not holding trades for longer than an hour or 2 hours. So we're trying to find areas that has volume like this. So how do we detect volume? Volume is very easy to find. So we can just look at this area here, right? This area here is what is considered a range. What is a range? A range is an area where there is not much volume, and it is also considered a consolidation. This area here is ranges. Of course, you can put it around here, which is a little bit more understandable. This is ranges, right? So prices would just range up, and then it just starts going. This area here is volume. So how do you detect volume? By looking at the market, right? You can see here, this is a range. This whole area here is a range. I mean, yeah, you can consider this as a range as well, but this is a very strong volume with ranges. So you can trade around these areas here. So this whole thing is a range with volume. How do you detect if there would be volumes going in after a range? Is by detecting key areas that has been liquidated. And what is thing areas that gets liquidated? There are areas that have not been touched, like this area here. This is what is called a fair value gap. Now, what is a fair value gap? So, fair value gap is basically a candle here, candle here. A fair value gap can only you can only consider a fair value gap if there are three same candles. Let's take this white candles as a bullish candle, right? So for you to detect if it's a fair value gap is if there are no wicks in between the top candle and the bottom, the top wick and the bottom wick. So this is considered a fair value gap. This little area here is considered a fair value gap. So prices would always lead going up and then it would need to retest, right? So you would be confused. Where would price retest to? It will retest to the areas that are considered a fair value gap, which is this. And it bounces back up. Of course, sometimes you can detect two fair value gaps or three fair value gaps. So you can mark those out and see where the prices touch. Sometimes the price would touch at one fair value gap and it goes to a second fair value gap. But most of the time, the maximum amount of fair value gaps that the price will be touching is two fair value gaps. And of course, it's the same thing as if it's a bottom wick. Let's make a bottom. candle. Okay, so this is a fair value gap. Just make an example. This is a fair value gap. Why? Because there are no liquidity in these areas. So prices would always go like price would go down. If it wants to go down even further, of course it will touch this fair gap first. It goes back down. That's a fair value gap. And knowing that, you can look at the market, detect a range. Okay, so let's see this. This area here is a range. Where do we want to see price head to? We want to see price heading to a fair value gap, which is this area here. This is a fair value gap. See, the price touched the wick touched the area and it starts going down. So knowing that, you understand shit. Okay, it touched a retest, broke structure, which is here, broke structure, retest again to this fair value gap, but this is not considered fair value gap. Why? Because the wick already filled the middle area. So it's most likely liquidity. Where would the liquidity come from? This area here, and you can see this area here. There are rejections before the price goes up. So you can consider this area as liquidity, this area as well. Touch this area for liquidity, drops down. And when you can detect a volume is when you see a very major candle going down and you see, okay, I'm gonna wait and see. If the price keeps going down, I'm not entering. Even though there's a good chance to enter, I'm not entering. Why? There's not much confirmation. So you would have to wait for an area like this to happen. A liquidity being formed or a retest. A retest to where exactly? This is not considered a fair value gap. But yeah, it is considered a fair value gap. To be honest, I didn't see this candle here. You can see here. See? Price touched the fair value gap again, it starts going down. So my entry would most likely be this area here. Because why? It broke structure from the previous low. My stop loss probably would be on top of this area here. And my take profit will probably be this previous area here. That's a really nice entry. So ranges and volumes aren't hard to understand. It's just understanding liquidity. And areas where you can consider liquidity is, let's say this, right? A very fast movement candle, like this candle right here. This is considered liquidity. Why? Because it made a really high wick and it went back down and starts going back up. So you can consider this a liquidity. And these areas here are people who enter trades, exit trades, made money, lost money. Every active trades there is are in these areas here. So this is liquidity. That's one way to detect liquidity. And how would you understand? How do I understand that this is liquidity? Where's the liquidity being formed? Most likely the top, because around these areas there's a lot of actions here. So people would assume, okay, if price goes up, of course I would enter, or of course I would sell. That's how liquidities get filled out and be formed. You can also detect around these areas here, which is considered liquidity, but we're in a 5 minute, so you will probably see, shit, it's kind of messy. Let's go to 15 minute and I'll show you a more simple example. This liquidity, this is considered liquidity, this is considered liquidity. Why? Because there's a rejection. There's not a strong movement up like this. Movements like this. So you can consider this area as liquidity. And what happened to the price? What happened to the price? It touched this area, made liquidity. This is liquidity right here. Went lower to grab more liquidity, which is this area here, which is also considered liquidity. So grab this area, starts moving up slowly. So liquidity, I will explain it a lot more later on, but all you need to understand is ranges. how do you detect ranges now? Is that when you see price movement going up and down like this, that is considered a range. So what we have to form is the previous high and the previous low of the whole range, which is this. This the previous high, and this the previous low, or which is considered this as a previous low, right? So that's basically it. This is liquidity. Where's liquidity coming from? This area here. And why is the price ranging here? Because there's liquidity here. Of course, there's rejections. So for you to understand when you can enter trades after a range is when it broke structure above and have a closing candle like this. This means that there will be volatility. You can see here, these these four candles are not considered an entry which you should be taking. Why? Because it didn't close above the range. So you would be fucked. Reason why you'd be fucked. Okay, let's say this, right? You enter a trade above this area here. Your stop loss is the previous low. You would get fucked. You get fucked out by the spread. Like, let's say you put this lower. You still get fucked out by the spread. That's why I would always recommend you entering trades outside a range with a confirmed candle like this. Okay, let's say this, right? This is a confirmed candle. All right, I understand that's a confirmed candle. So what's next? Most likely more drive up. So what will I do? I'll wait for a good move down back to the resistance. This support, okay, this resistance is now support. So it moved back down. I'll probably enter around here, not here, because who can like really see or understand that it would probably go lower, right? So I'm gonna probably put my stop loss under this area here, and my take profit would just let it run. I just let it run because why? I know that there would be more volume in the market for the market to move higher. Why? Because of this confirmed candle. So right when it moved above this area here or this area here, which is considered liquidity, right? Right when it moved above this area here, I just put my stop loss. I just put my break even on the trade. It doesn't matter if it goes back down. Why? Because I'm already taking profit around these areas here, which I can easily take. Okay, so I won that trade. What do I do next? Do you want to enter another trade? Yes, of course you can. Why? Because you know there's volume in the trade. So what do you find? So now that it broke structure, right? What do you expect the price would do? I would expect the price to consolidate a bit or create a new range. So I'm going to take the previous high and the previous low, which was this. This is what we're looking at now. So what do I do? What do I expect the price to be like? I would expect the price to, if the price gets out of the range. Okay, I wouldn't consider this as a recent high because we're still focusing on this area. So we can go around this area here. Yeah, let's go around these areas here. Because it would look more confusing, but I can explain to you as to why or how you can detect it. Say this. Let's say this. So the range close above. But I start moving down. So you're kind of like fucking frightful. What do I do? Okay, so same analogy. This is liquidity. This is probably most likely just a retest. So I enter around these areas here. Where is my stop loss? Most likely on top of these areas here, which is the recent break of structure. And my take profits, I'm gonna just let it run because I know there's volume. But most likely I would take profit from this area here, this whole move here, because I'm only gonna be trading for like less than an hour. So this area here is my take profit. I still be making a lot. 90 pips. Think about it. That's how you detect a range and volume, is understanding that there are areas where price needs to consolidate to really push the price up higher or lower. You can take an example of this. Yeah, this is a range as well. Why? Why is it consolidating here? Because this is a recent low and there's also liquidity. So people would probably enter sells here. They make some profit or probably lose all of it because, of course, this is also considered liquidity. So it went down, grabbed hard as fuck, starts going up. Why did it do that? Because of this area here. There's no liquidity being formed. It needs to be filled. So it went down, grabbed liquidity, and then starts going up. This is a range. So what will I do? I would most likely put this area here as the recent high and this area here as the recent low. So if example price would go up like this, retest it, and it goes back down, I wouldn't enter around here. No, I would enter around these areas here. And when it starts going down even further, I'm gonna just put my stop loss to break even. So price would go above this area, confirmed above this area. Of course, there would be retracements like this. So I would enter a buy here. Recent low, which is around this area, or you can put this area here. But you really need to tweak out on how the market works. Depends on what you're trading, depends on what pair you're trading, depends on how you're trading. My take profit is most likely around this area here. Right when it moves up, I'm just point to break even. I'm good to go. It's still a good profit. Why? Why is it a good profit? You think it's small? No, it is not small at all. It's huge. It's 80 pips. So what I want you to focus on is prioritize breaking even, because breaking even is the best phase you want to be in. Understand that not all trades are tradable, or not all market will give you an opportunity to trade. Just these two. Range is very easy to understand. You can just look here, right? This is a range. So what do you expect it to do? Most likely capture all it needs above this area, and it starts going down. Where would you expect the price to go down? Most likely here. Why? Because there's a fair value gap from this recent high and this recent low. There's a wick here and there's a wick here, and it did not fill the whole area. It did not fill this whole area, so you expect the price to go around these areas here, which is also considered like, the recent high. So maximum area would probably be around here. So it goes down. Let's say it goes up, goes down all the way here, probably consolidates, most likely break structure, so it goes down even further to grab another liquidity and then starts going back up. That's if it's just pure price, just pure market. If there's no news. So fair value gap is areas that have 3 candles and that has not been touched. This area here is free liquidity, so the price is attracted to these areas here. Let's find a liquidity to the downside. This is liquidity to the downside, but you can't really use this because why? You're trading against the trend, so why would you enter a sell here, right? But it's just an example. Look, it touches area, went back down, and it goes back up. Let's go and find a bearish trend. Okay, this is a bearish trend. Let's take an example of this, right? So this area here is a fair value gap. The small area here touched it, went back down. It's very, very simple. So I want you guys to get on the market, look at the chart and detect 5 fair value gaps, and look at how the price works after it touched the fair value gap, and understand and see where prices are ranging. Like these areas here is what prices are ranging. So what will I do in this area here? It's very simple, dude. It's an A plus setup. Broke structure here, confirmed candle under. I would just literally enter here. My stop loss is above this area here. And my take profit most likely at this area, which is liquidity. Why? Look over here. This is some resistance to the price moving up, so I will consider this as my first take profit. It's still a very good amount. You don't need to capture all of the move as long as you have some piece of the move, you're gonna be okay. It is still 118 fucking pips, which is amazing. This would, if you're trading $100, this would literally give you $900 or $1,000. It's that simple. But yeah, for today's class, it's just ranges, detecting the recent high, the recent bottom, and that can be considered a range if it doesn't have much volatility. This is a range. This is a range. This is a range. This is a range. This is not a range. This is volume. Volume to the upside. This is volume. This is a range. This is volume. Range. Volume. Range. Volume. Range. Volume. Range. Volume. Range. Volume. So on and so forth. Look, range, volume, range, volume, range, volume, range, volume, ranging again, volume, range, and then volume again. Break of structure, volume. So break of structure went through a fair value gap, went through two fair value gaps. So that means the price is bullish. After a break of structure, no retest. And this was the break of structure. This was the major break of structure. So there's no retest. So what do you expect? More volume. I would enter a trade above this area here. Take profit around this area here. Stop loss around under here. Still good trade. 59 pips. It's crazy. Range, range, volume. Range, volume. Volume. Range, volume. Volume. Range, volume. Range, volume. It's very easy to understand. Just get on the get on the chart and just have more experience. You'll understand and see this immediately. Range, volume, range, ranging right here. So what will I do? I will put a resistance here, support here. If it breaks through this area, I wait for a retest. Oh, retest is here. Look, it's very simple. Okay, so it broke through the range, went back down, grabbed more liquidity. I would enter the trade. This trade would be very, very difficult for you to handle, but you would still make a lot of profit. Where would I most likely take profit? I would probably most likely take profit. Like, okay, let's say I will enter here, right? Stop loss under here. Why? Because it's back in the range. Take profit, most likely recent high or recent liquidity, which is here. There we go. It's that simple. But of course, most likely you can't get this because of spread. So just take profit there. Or just let it run. It really depends. But I will most likely just take this area here. I wouldn't take the whole area. No, fuck that. It's still 98 pips, which is good. So yeah, go through what I've said and just look over the market. Look over the charts. See if there's any fair value gap it touched and then it retraced back down. This here is not a fair value gap, but it is considered free liquidity, so the price would most likely drive up, touch this area, went back down. Candles that has not been filled up by wicks are liquidity areas. No, not liquidity areas, are free liquidity areas. So the price are attracted to those areas. Yeah, that's basically it. See you guys tomorrow. Bye bye.